Welcome to This Explainer. Today, we're going to completely flip the script on how you think about building wealth. See, most of us grew up believing that to actually build a massive retirement corpus, you either need a giant six-figure salary or you just have to get incredibly lucky. But what if I told you the truth is actually a lot quieter, way simpler, and absolutely within your grasp? We're going to look at the undeniable math behind building a total financial fortress, using literally nothing but time and discipline.
Okay, let's dive into this with a question that sounds, well, kind of ridiculous. Can a 20 rupee daily chai buy a luxury vacation? I mean, no way, right? We barely even notice 20 bucks leaving our wallets. But this hits the nail right on the head when it comes to the biggest myth of wealth creation. We tend to think those tiny amounts of money just don't matter. But here's the reality. A small, consistent amount, money you honestly won't even miss, can, over time, build a corpus so massive that you could retire a whole decade earlier than your colleagues. The bridge between that daily cup of tea and a luxury vacation? It is definitely not a high salary. It actually all comes down to what Albert Einstein supposedly called the eighth wonder of the world, compounding. Compounding is the real, hidden secret to wealth. Think of it like this. It's just the process of your money earning returns, and then, here's the kicker, those returns start earning their own returns. It's this mathematical engine that once you turn it on, just works relentlessly in the background of your life. But, how do everyday people actually harness this wonder of the world without spending 24/7 staring at stock charts?
The secret weapon? Systematic investment plans.
Everyone calls it a SIP. Think of a SIP as your ultimate financial autopilot. Instead of trying to save up some massive lump sum, or even worse, trying to guess the absolute perfect moment to jump into the market, which, by the way, even the pros on Wall Street get wrong all the time, you just invest a fixed amount every single month into a mutual fund. It could be 1,000 rupees, it could be 5,000. Honestly, the exact amount matters way less than the actual mechanism of doing it. Because by investing consistently, you are completely removing all the guesswork and all the stress from investing.
And when you put your money on this autopilot, you trigger what we call the snowball effect. I absolutely love this analogy because it takes the complex math of compounding and makes it super intuitive. Just picture a tiny snowball rolling down a long, snow-covered hill. Now, at first, it's really small, right? Its growth is super slow, and honestly, you might not even notice it getting bigger. But as it keeps rolling, it just gathers more and more snow. It gains mass, it accelerates, and the longer that hill is, the more unstoppable that snowball becomes. In the investing world, your monthly SIP is that tiny snowball, and the hill, that is the time you leave it in the market.
The undeniable proof. Visualizing time.
Let's walk through a scenario with three friends, Rohan, Simran, and Amit. They've all got the exact same goal, and they all decide to invest the exact same amount, a 10,000 rupee monthly SIP, into a well-managed fund. Literally the only variable here is when they start. So, Rohan starts early, right at age 25. He's going to invest for 35 years until age 60, putting in a total of 42 lakh rupees out of his own pocket. Now, Simran waits just a little bit and starts at age 30. Over her 30 years, she invests 36 lakhs. And Amit, he waits until he's 35, investing for 25 years with a total contribution of 30 lakhs. Keep those start dates in the back of your mind. Now, what's really interesting about this is the final tally. Assuming a pretty standard estimated 12% return, let's look at their wealth at age 60. Amit, our late starter, ends up with roughly 1.9 crore rupees. Not bad. Simran ends up with a very respectable 3.5 crore. But look at Rohan. Rohan ends up with a staggering 5.6 crore rupees. Seriously, just look at the gap between Rohan and Simran. Rohan started just 5 years earlier. He only put in 6 lakh rupees more of his own money, yet his final corpus is over 2 crore rupees larger than hers. That is the literally mind-blowing power of the snowball rolling down a longer hill. For Amit to even try to catch up to Rohan's 5.6 crores, he'd have to invest over $30,000 a month starting at age 40.
15.9 crore rupees. I know, it looks like a typo or maybe a crazy lottery jackpot, but incredibly, it's neither.
That massive number actually comes straight from real-world, historical market data. Check this out. If an investor had just maintained a disciplined 10,000 rupee monthly SIP in the HDFC Balanced Advantage Fund from 1994 to 2026, their total out-of-pocket investment of 38.4 lakhs would have grown to approximately 15.9 crores. I mean, that is absolutely phenomenal. We're talking decades of disciplined investing, simply refusing to interrupt the snowball. It leads to wealth creation that just completely defies human intuition.
The obstacle, slaying the volatility monster.
Now, obviously, if it were that easy, everyone would be doing it, which brings us to the single biggest roadblock. Markets will crash, period. It is an absolute certainty. It's never a matter of if, it's just when. Look at the history here. In 2008, the market fell by almost 60%. In 2020, during the pandemic, it fell 38%. In 2022, it dropped almost 18%. And look, when you log into your portfolio and see your hard-earned cash dropping by those kinds of percentages, your very first deeply human instinct is going to be to panic. You're going to want to stop your SIP to, stop the bleeding. But the data definitively shows that stopping your SIP during a crash is one of the worst financial mistakes you can possibly make.
And here is exactly why you shouldn't panic. It's a brilliant concept called rupee cost averaging. You honestly just need to completely reframe how you view market crashes. A crash is not a loss unless you actually sell. Instead, think of a crash as a massive, massive discount. See, because your SIP is an automated fixed amount, when the market drops, the price of those mutual fund units drops right along with it. So your 10,000 rupees suddenly buys significantly more units of that same fund. You are essentially out there shopping for premium assets on clearance. By maintaining your SIP during the crash, you accumulate way more units at rock bottom, which profoundly accelerates your wealth the second the market inevitably bounces back.
So the crucial point is this: zoom out. History shows us that every single major crash is followed by a recovery. I mean, that brutal 2008 crash, it gave way to massive 20% and 16% returns in the years that followed. The 2020 pandemic crash was followed by a 22% return over just 3 years. Now, while the past doesn't guarantee the future, just look at the long-term trend of the Indian stock market. Since 1986, the Sensex has delivered a compound annual growth rate, which is basically the average rate your money grows each year with compounding, of about 13.5%. It has grown 141 times over, from below 1,000 all the way to well above 75,000 in 2025. The long-term trend is stubbornly, consistently upward.
Action plan: choosing your first fund.
Okay, let's pivot from theory to practice. When you are just getting started, you really want a rock-solid core for your portfolio. The source data points us towards large-cap funds, which invest in the biggest, most established companies, or flexi-cap funds, which adapt by investing across all company sizes. Take a look at these two historically backed examples. The ICICI Prudential Blue Chip Fund has shown a 5-year CAGR of roughly 13 to 14%, and it's actually outperformed its benchmark in about 70% of rolling periods. On the flip side, the SBI Blue Chip Fund has shown a 14 to 15% 5-year CAGR with relatively low to moderate risk. Listen, these aren't wild, speculative bets. These are the robust, foundational funds that are absolutely perfect for building that long-term snowball.
So, let's bring the whole shebang together into one beautifully simple formula for financial freedom. Rule number 1, start early to maximize your time on that hill. Remember Rohan's 2 crore advantage over Simran? Rule number 2, stay consistent over decades. Consistency over the long haul will mathematically beat trying to perfectly time the market with lump sum investments every single time. And rule number 3, ignore the crashes. When the market turns red, embrace rupee cost averaging and just enjoy scooping up all those discounted units.
And hey, if you're still sitting there thinking, well, I just don't have enough spare cash to start, consider this number: 41,380. Even a tiny, practically invisible SIP of just 500 rupees a month can grow to roughly that amount in just 5 years. Over 15 years, that same 500 rupee SIP can grow to over 2.5 lakh rupees. Literally anyone can pack that very first snowball and give it a push.
I really want to leave you with this final, powerful thought. The difference between a lifetime of financial stress and true financial freedom, it isn't the size of your salary. It is entirely dependent on your start date. By starting a SIP, you are actively harnessing compounding, you're placing a smart bet on long-term growth, and you are finally taking control of your future. The data is clear, the path is incredibly simple, and the autopilot is ready and waiting. So the only real question left to answer is, will you start today?